Welcome back. A couple of days ago, we talked about the rapid decline of the 1 month Treasury Bill. And in particular, we spoke about the looks like an ocean wave kind of moving across the Treasury yield. So, I wanted to kind of draw the picture if possible. We see here on the left hand side the blue chart. This shows a U.S. Treasury market as of January 2023, just a few months ago. The 1 month bond pays a 4.58, the 3 month at a 4.70. The highest yield we see is the 6 month at a 4.80, and then we have, of course, the inverted bond market with a 10-year paying at 3.52. Now, notice what happens as we progress forward in time. Again, this is what the Treasury market looked like in January. We change this to February, and in particular, notice the 1 month bill drops to a 4.65. Again, going back to January, this is what January looked like. A little bit of an inversion on the lower end of the curve, but still, somewhat flat. We see more of a dramatic drop on the 1 month. We go to March of this year, and we see the long-term rates, the 5-year, the 10-year, really drop. The 10 years now to 3.48. And then notice what happens between March and April. All of a sudden, we see that huge drop on the 1 month. The 1 month drops down to a 3.36. Again, so let's go back to January. Now, I don't know if it's fair to make 100% comparison between the two markets, but there are some similarities. The right-hand chart shows us what the Treasury market looked like in October of 2006. We had the 1 month bond paying a 5.18, the 3 month at a 5.08, the 4 month at a 5.13. Of course, the 5 and 10 years are much lower down. The slope is very similar. Of course, it's not a one-for-one match, but the slope is very similar. Now, notice the similarities. We have January 2023, October 2006. Now we go to February 2023 on the left-hand side, and we see the 1 month starts to drop. We see more of a dramatic top over here on the 6 month. Now the 6 month does not remain the highest yield. We're going to see that in a second. Notice as we go from October to November of 06, we see the same situation. We see a real drop on the longer term end. We go to March on the left hand side, March 2023, and that looks very, very similar to what we see November. And then December of 2006, notice what happens in December. All of a sudden, that 1 month drop, huge drop. Again, this is November 2006. The 1 month bond pays a 5.22. The 3 month at a 5.03. December, in 1 month, 5.22 drops down to 4.75. Left hand side of the chart, March, the 1 month pays a 4.74. April, the 1 month pays a 3.36. And it's really the same kind of chart. We have a rapid drop on the very short term, and then we have a slope down to the inversion on the 10-year and the 5-year, which really represents the lowest ends of the maturities. Now, this looks to be the same in April of 2023, current month, and December 06. Of course, every market's different. So we're not saying that 2023 is going to follow exactly what the bond market did in 2006 and 2007, but the similarities are pretty interesting. Now we go to the left-hand side. The green chart over here shows us the 1 month bond. That's the white line, the 1 month bill, I should say. The red line is the 1 year. The light blue line is the 5-year, and the purple line is the 10-year. On the right-hand side shows us the S&P 500 in yellow. Now these charts move from October 06 through February 07. But as we progress forward in time, we'll see how these charts do change. So again, focusing on number one, the 1 month bill, the white line. As we see November, and we see the longer term rates, especially the 10-year and the 5-year, even the 1 year for that matter, really start to drop down. That's a separation. Again, we go from October 06 to November. Then we move to December of 06. Now that was really when the 1 month really started to capitulate. And we see that right over here. On the left-hand side of this chart, we see the 1 month really cross down. Further on down to the right-hand side, we see February, March of 07, the 1 month bond does recover. So this is a cycle, I think, that may repeat itself several times. The cycle is as follows, where we see the longer term rates, like the 5-year and the 10-year, and in this case even the 1 year, really drop down as the bond market's telling us over the long term we expect to see lower interest rates, meaning the bond market sees weakness in the distant future. But then the real trigger when weakness really starts to appear is when the 1 month bond really collapses. That's more of the immediate trigger. Now notice when the 1 month bond drops down. We were at a 521 December 06, and then coming into 07, early 07, 2006, and then later on, this is December 06, between November and December 06, that's when you see that precipitous drop in the 1 month. Now, this occurred while the S&P 500 was still moving higher. In fact, the S&P 500 really doesn't make a big move down until December 07. Point being, and we can see the confirmation from the red line, the 1 year. The 1 year really, I think, follows closer to the actual market action, meaning the S&P 500. But the 1 month does forecast, I think, to an extent, what may happen down the road in the 1 year. Now, fast forward to present date, we see on the left-hand side, this is starting off in January of this year, 2023. The 1 month bill, again, is the white line. We see this huge drop. This happened just now. It's actually April. This shows us from December 22 to present date. The red line is a 1 year, which is now chugging back to the upside. Again, this, I think, is much more representative of what the stock market is doing, the 1 year bond. But the 1 month, again, could forecast what the 1 year is going to do. And that is really a very significant drop because now it's down below the 5-year and the 10-year. So point being is that we're going to watch this very carefully, but I think what we see is a rolling of the interest rates, meaning that we have the higher rates on the short end of the curve, meaning that the 1 year is higher than the 5-year, the 1 year is higher than the 10-year, and the 1 month bond, or the 1 month bill, I should say, is also along those lines, along those yield curve as well. But when we start to see the 1 month bill really start to collapse, perhaps that could forecast a move in the 1 year. And if you recall some of our earlier discussions about the inverted bond yield curve and how it ends and the stock markets that ensue afterwards, it usually coincides with the S&P 500 going down a lot, coinciding with the 1 year bond really collapsing. So it'll be very interesting to see how this plays out. And of course, we'll update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.